Okay, just want to say good morning and welcome everyone. Thank you for this collaboration and using the Business Resource Center here at we have the New Mexico MBDA located in here, and we have other resources like the SBO, and we are welcoming everyone to use our resources here in the conference room. Also, we just to let everyone know that we support and assist minority owned, I should say every business, with technical assistance, one-on-one consulting, professional services that are for free, like video creation, website creation, logo, business design, business card design, and participation with one-on-one events and also educational services. So thank you so much and welcome, and pleased to have Bernalillo County here talking about business property, personal business property taxes. So please take it away, Tyler.
Thank you all for having me. So first off, I'd like to introduce myself. My name is Tyler Smith. I'm the Business Personal Property Supervisor for Bernalillo County. So we kind of just wanted to kind of go into, because we realize a lot of small businesses may get overwhelmed about how to go about filling out these yearly reports every year. So we're here to walk through make sure that everybody is taxed properly and fairly and equitably. Sorry for the technical difficulty. Do you know how I'm supposed to go to the next slide?
Yes.
Oh, yeah. Oh, just click it. Oh, okay. Sorry about that. So first off, we're just going to go over what is business personal property. And then we'll go into learning more about the state laws. And then we'll go into the tax forms that you'd be looking for to be able to get your true values. And then we'll go through some example calculations to kind of like walk you through on how you go about the different types of assets and everything from there. And then we're here to answer any and every question that you guys could possibly have. And then even at the end, if you guys want to have like a small session where we step aside, we can answer your confidential questions. But if you want to go into more depth, we can do that as well. All right. So we are one team. Most of us live, work, and shop in here in New Mexico. We work to serve the county businesses by educating them about the laws about business personal property. So first off, to start with, what is business personal property? Business personal property is not something that people are very familiar with. When I came into the position, I kind of realized that we needed to do more outreach to actually inform the public on what this is. This is a state statute that's been in law since 1978. And so we get many calls, or business has been like, I've been in business for 10 plus years. I've never had to do this before. Why am I starting to have to do this now? And it was because of that canvassing outreach project that we started to do, where we realized that we hadn't accounted for many of the businesses here in the county. So this year we're making significant strides to get to where we need to be to account for every single business here in the county. So let's go into what it is exactly. So business personal property consists of movable items that are not permanently affixed to or a part of the real estate itself. Business personal property can be known as personality or chatels. You rarely hear those terms, but if you do, it's business personal property. So, but some things to take into considerations is the manner in which the business personal property is annexed. So it's the intention of use of the asset. Is it meant to be permanently left there if business moves or ceases or relocates? Or is it meant to be taken with them when the business moves? So the purpose for which the premises are used are kind of on an item to item basis. And we'll kind of go through more of that, and you can always ask us more questions on what is considered part of the actual real estate itself and what is actually considered business personal property. And an overall thing is, can the asset be moved without creating damage to the building or any of the structure itself? Oh, shoot. I went too far. Someone help me go backwards. Yeah. All right.
Does the arrow work?
There does not work. Oh, there it goes.
There,
Oh,
right
there. Thank you. Yes. A little louder? Okay. So what it kind of comes down to is the asset tangible or is it intangible? So some of your tangible assets are going to be more like tools, your equipment, your machinery, your furniture, computer equipment, and other varying assets that make the business function itself. So tangible assets are the physical and measurable assets that are used in a company's operations. Assets such as property, plant, equipment are tangible assets. Tangible assets form the backbone of a company's business by providing the means by which the company produces their goods and services. Tangible assets can be damaged by naturally occurring events. So, tangible personal property is held by businesses, including their machinery, their tools, furniture, fixtures, equipment, and supplies, materials and supplies normally used in the business, and inventories held for resale are exempt unless the owner has claimed a depreciation deduction on them. And we'll go more into depreciation here in a little bit. But it's for if they've claimed depreciation on their federal tax purposes in the immediate preceding 12 months of the year. So intangible personal assets and other assets that are not to be reported. So some intangible assets that may have depreciation taken on them are such things as like franchise fees, labor costs, lawyer fees, architectural fees, goodwill write-offs, design costs, different types of those type of things. Those are not to be reported. Another thing that is not to be reported that many people get kind of confused on and they feel like it's a gray area sometimes is what we call leasehold improvements. Leasehold improvements are improvements to the structure or the building itself. These can be like your HVAC, your furnace, your roofing, remodel costs, electrical upgrades, different types of those, carpeting, recess lighting, different types of things like that. Those are not things that you're going to typically take with you when you relocate your business. Another big thing that you should not report is vehicles that are licensed with the MVD. So, because you're going to be paying taxes on it through MVD and through there and not through us. Where some people get a little bit of confusion on is because typically some tractors, your ATVs, your forklifts and stuff like that, those aren't going to be registered with the MVD. So those are actually to be reported to us as business personal property. So this is the main statute that we kind of like base of everything that we kind of go off of. The big part of it is for which the owner has claimed a deduction for depreciation for federal income tax purposes during any federal income taxable year occurring in whole or in part of the 12 months immediately preceding the first day of the property tax year. So now we'll kind of just go through some basics on how to get your report started. So this will be like the first page that you would receive in the mail. This is your instruction sheet, kind of breaking down basically kind of what we already kind of went over, what is business personal property. And then you got your instruction sheet that walks you through line by line on how to fill out a report. And we'll go through more of those steps and everything. But if you want to dig into some more details there and you get caught up on the line, refer back to this instruction sheet. It's very, very helpful. If you're still confused, feel free to give us a call. Our team is more than willing to help walk you guys through it. This is the form itself. You always want to make sure to include your UPC number. So that way we make sure that we get the information associated with the right account. We don't want to apply your guys' tax documentation and valuation to the wrong account. We, of course, always do our due diligence to make sure that we are applying the right information to the right account. But your UPC number is basically your account number that ties everything together. Any potential updates that you may need to make, like say from one year to the next, you decided to relocate. You're going to want to make sure to update that on line 4 here, saying that you relocated or moved. So a big thing with business personal property here in New Mexico, we're a self-rendering county. Any significant changes to the business is the responsibility of the owner or their representative's responsibility to let us know the significant change that took place. So a lot of people think, okay, I closed my business, I closed my CRS number, I'm good, I'm done with it. Nope, there's another step that you need to take. You need to let us know here at the county that the business closed. Because of manpower, like we have a solid team, but we can't possibly reach every single business that closes or starts up and everything. So we need to be notified that the business has closed, because we don't want a situation where the business closed, they think they've taken care of everything, but they forgot our step to let us know that they closed and that we should deactivate their account. If they didn't let us know and we don't catch it on our own research, there's potential for that account value to just roll over to the next year. And then all of a sudden they're getting a tax bill. They're like, why am I getting a tax bill for a year that I've been closed? And it's like, well, you didn't do your due diligence and letting us know and self-reporting that you have closed. So it's very, very important to let us know of any significant changes to the business that's taking place.
Senator, can I
Yes.
ask a question? You said, yeah, UPC is the account number. That is when we as a business create the account with you guys, or?
Yes, so the UPC number is for our office's use.
Okay.
It's not your CRS number, it's not your city facility ID number or anything like that. That's our specific, we have many different terms for it in our office. Sometimes we refer to it as parcel, sometimes we refer to it as UPC number, sometimes we refer to it as account number. All means the same thing in our office.
Okay, but this number is when we start creating when we start filing this personal
Yes.
property tax.
Yes, but if you don't have an account and you're filling out this report, you're going to want to put new
Okay.
in UPC, and then we will generate a UPC number for you. And then from there, you always know what your account number is. Because that UPC number will come in on what's called your notice of value. That kind of dictates what number you're going to want to reference for the life of your business. On the second page here is where we dig into more of the calculation of how we determine the actual value to be assessed. But we'll dig into some more of that on some example stuff. But a big portion here that many people forget about, we have it highlighted here. supporting federal tax documentation is required for all accounts. So even if you're reporting zero assets, you still need to justify that with your federal tax documents. We'll go through the different tax documents that can justify a zero for you. But a lot of people think that they can just write a big zero here on the second page, turn it in, and they think that they're good. That is considered an incomplete report. Okay, and we'll go into more of the ramifications of what can happen if you submit an incomplete report. We have such a great team that this year we've been trying to reach out to all the incomplete reports to let them know that they have not submitted a fully justified document yet. We need to let them know that there's always got to be federal tax documents accompanying it to be able to validate your value. Because anybody can just write a zero on there and then turn it in. Like say Amazon writes a zero on it, turns it in, and we're like, that's not true. There's almost 0% chance that a company of that size would have zero value. So there's always got to be a justification, because anybody can just put a zero or any value in there. We want to make sure that you're assessed fairly and equitably. This is our percent good schedule. It's going to be the third page that you receive in the report that gets mailed out. It tells you how to go about calculating your depreciated cost. We'll do that when we go through a few different examples. But here you get different class lives. So our main three class lives that we deal with are typically these three right here. 3-year class life, 6-year class life, and a 10-year class life. That covers the majority, probably like 85, 90% of the assets that may be reported. So our 3-year class life, and I know it's hard to read here, but that's mainly your software. Software that is to be reported is software that is distributed for general use. If it's a software that's built specifically for your company, then that is not to be reported. But if you're renewing like an Adobe license or Microsoft 365, that is something that is to be reported. 6-year class life is going to be more of your digital type of assets, more of your computers, your printers, your LED displays, your TVs. Those are going to fit into your 6-year class life. 10-year class life is more broad, but it encompasses lots of what would be reported. It's going to be your furniture, it's going to be your desks, it's going to be your chairs, it's going to be your forklifts, it's going to be your appliances. Could be different types of stuff for like your restaurant equipment, your ranges, your ovens, all different types of stuff like that. And then of course like your gym equipment, any type of stuff like that may come into play right there. Your second page is going to be more of your unique items. So like 14 is going to be like your chemical processing equipment. 15 trash receptacle, 20 solar panels, 25 gas and purification, and then 45 is going to be like very rare, like your bank vaults and stuff like that. And steel billboards, excuse me. And so as we were discussing before, when a business has ceased or has been sold, make sure to fill out line 21 or 22. We pay very, very close attention to those two lines because we do not want your value to roll over for a year in which you aren't active. So please, if any significant change like that, make sure to fill out that line 21 or 22. And this is just kind of an example one that we kind of wrote up as like a pretend business that we have here. So any changes that you want to make, if you want to change your point of contact, if you want to change your mailing address, if you want to shift it from the actual location itself to a PO box, fill it out there. Your DBA is what you're doing business as. So there may be like an umbrella company that owns it, but what is the sign that is outside your business that's representing yourself? That's your doing business as. And then over in here, when you're filling this out, it's your CRS number, your city facility ID number, or your county business registration. We like to say, because you may not have all three. If you have one of those three, you're good to go. We have a point of reference to go off of from that. So if you can get one of those three for us, we are very happy with that. And then from there, looking into which tax district your location actually goes into, so that way the funds are attributed proportionately. Is the right word. We don't want if you're located in Tejedas, but you're reporting that you're within an A1A district of inside Albuquerque, those funds will be attributed to inside Albuquerque and may not get proportionally distributed out to Tejedas. So make sure that you kind of know where the location of the business actually is. And then from here is just your contact information, just in case if you have any questions or if we have any follow-ups with you, if we're reading through the report, something seems a little fishy or something seems a little bit off. That way we have a point of contact to follow up with you guys to make sure that we get it right. Because our office's motto is to be assessed fairly and equitably. We don't want people to be overtaxed. We don't want people to be undertaxed. We want to make sure that they're taxed exactly where they're supposed to be. So from here is what kind of, excuse me, my voice is kind of going out. The tax forms to validate the report is kind of like what we'll go through here. There's different kind of benchmarks that we'll kind of go through. Most of your small businesses may actually be what we consider an active business with zero taxable value. So those ones are very easy to determine. We'll kind of go through those types of forms and everything from there. But a big point to kind of notice is, so we all know that your IRS filing date is in April of every year. Our deadline is at the end of February of every year. So there's a gray area there. So our office lets you use your prior year's return. So for this year of tax order of 2025, we're letting people use their 2023 tax IRS filings to be able to report. And you'll basically just be reporting a year in the rear every single year, kind of from there on. It's very few businesses have all their stuff ready to go for their 2024 IRS filing right off the bat at the beginning of the year. Typically, people do their taxes between February, March, and I think beginning of April. So we always want to let people know that you can use your 2023 because we have people that'll turn in late reports because they're like, oh, I don't have my 2024s ready yet. How can I do this report yet? So they'll hold off, and then therefore they're getting assessed the late penalty because they're turning in the report after the end of February. So you want to, for your businesses or anybody that you guys are working with, let them know that they can utilize the 2023s. First one, most clear cut that we kind of point businesses to just as a starting ground is going to be what's called your Schedule C. If you find your Schedule C, you see on line 13, and if it's blank or has a 0, you just stop right there, attach your Schedule C to your form, write that you're at 0 value. That is a fully justified report. You are an active business with 0 taxable value, because therefore you're not claiming any depreciation.
You're allowed to redact their social
Yes.
only.
Yes, and so a lot of people get a little sketchy with turning in a lot of their tax forms and stuff like that. You are allowed to redact your social security number, but please do not modify the form in any other. It's going to be a similar situation with your form 4562. There's a depreciation line. If it's blank or if it's zero, attach it. You're good to go. You're an active business with zero taxable value. Same situation with your 1120. Depreciation line, zero or if it's blank. Turn that in. You're good to go. But the thing is, and then here's your 1120S. If you're an S Corp type business, then you would have this. If it's blank or if it's zero, attach that active business with zero taxable value. But if on any of these forms, if there's value in this depreciation line, you're going to want to pull your 4562. And within your 4562 is going to have your depreciation and amortization report, or some people call it their depreciation schedule. It's going to be an asset list of everything that they're made and depreciation that's taken on. And that kind of looks more like this. So this is the front portion of your 4562. But this is kind of like a standard. You'll see different kind of modifications of the format of it, but this is typically what you'll see. The key parts in seeing your depreciation and amortization report / depreciation schedule is going to be your asset description, date and service, your cost. We'll go into section 179. I don't want to overwhelm you guys with that right now, but that is going to be a key part that we'll go into here in a few slides. But the most important thing is going to be your current depreciation column. There's value on your current depreciation column, then you're going to need to evaluate that's an asset that's to actually be reported. But if you pull up your depreciation and amortization report and you got all zeros, then you'll go into more of your section 179 stuff, which we'll go into here in a little bit. But most likely you're going to be a justified zero if you have zeros for all of your current depreciation. All right, so we'll do a couple of examples of calculating the depreciated cost. You're always going to want to refer to our depreciation percent good schedule, because a lot of people will look at their depreciation and amortization report and they'll see that on their IRS filing it says that their asset is a class life 5 or it's a class life 7, or the state of New Mexico does not recognize those class lives for these type of assets. So we've condensed our percent good schedule for the ones that we do recognize. You'll always want to reference our percent good schedule and not the class life schedule that's on the IRS form itself. All right, so we got an example here. So say we got purchased a 2022 computer. It has a current depreciation, has value in the current depreciation column. You're going to know, okay, computer, that's going to be a tangible asset that's going to be reported. That has current depreciation, that's an asset that's to be reported. You're going to want to go to your acquisition cost. So you purchased, say you can purchase the computer for $2,000. Computers fit under a class life 6. And you're going to want to go to your 2022 acquisition year. So a 2022 acquisition year, class life 6, it's going to be 64%. You're going to want to take your acquisition cost of $2,000 for the computer times 64% to get 1,280 as your depreciated reportable cost. And then from there, you kind of, as you're going through it, you'll add it all up as your summary at the total. So we'll kind of go through a little bit more of that. But is there any, before I keep, let me know if I'm going too fast or if I'm jumping ahead or anything. If you guys have any questions, please let me know. Sometimes I have a tendency to, where I just start going and let me know. But if you guys have any questions, feel free to stop me. Okay? But does this kind of make sense? So we got a 2022 asset. We figure out our percentage, multiply it. That's our depreciated reportable cost. All right. Now, here's our section 179. Section 179 basically allows the business to fully expense that asset's depreciation all in one single year. So they can write off that asset all in one single year of that given tax year. So, for example, for this one, we got a depreciation and amortization report for tax year 2023. We have a 2023 year asset for a forklift of $10,000. That's section 179 of the $10,000. It cut off zero here. I did my formatting. I apologize for that. So that is going to be an asset that is to be reportable because it is being expensed out at one single given year. So for this particular asset, it's calculated basically the same. You've determined that this is an asset that is to be reported because it is a current section 179. Like I was saying, 2023 year tax form, 2023 year asset has value in section 179. It is an asset that is to be reported. So we're going to take $10,000 and go back there. So forklifts fit under a 10-year class life. The 2023 year asset, 87%. So we're into $10,000 times 87%. $8,700 is going to be your depreciated reportable cost. That's going to be what you'll write on that second page of the form. Some people, if they have many assets, they'll do their own calculation page. If it doesn't fit on our backside of the form, that's completely fine with us. As long as the tax documents are attached, it is a complete report.
Question.
Yeah.
So if the date in service is like 2020, we don't report it because it was for a different year, or do we still report it with the section 179?
You wouldn't, because it would have been section 179 in 2020.
So it only applies to the year that it's, if the years match.
Yes, if it's the year of the form. So it would have been fully expensed in 2020. So therefore, there is no current depreciation on it because there was the depreciation on it in 2020. Oh, shit.
Yeah, let me check.
What's that?
Just interject on that one.
Oh, yeah, for sure. Jump in.
So on section 179, also the special depreciation allowance is sometimes combined on that line, letting you accelerate. So make sure that the current depreciation for that year is a zero, and it's not just accelerated for that tax year. And they still have some left over.
Okay, so anytime the current depreciation is zero, it's not, doesn't need to be reported.
Correct. If it's a current
Mhm.
value zero, then it doesn't need to be reported unless it's a section 179 of the same tax year.
Okay.
Sorry.
All right, good
Thank
point.
you.
Thank you for that, Sean. Thank you. Oh, jeez. And then from here, we basically go through it line by line. all the assets that you've determined to be reportable. You calculated it out, you get your total depreciated cost. That's your value that you're reporting to the county that you should be taxed on. This value, 1/3 of that is taxable. So that 33% of the 16,444 is gonna be your taxable value. That value gets sent off to be multiplied against what's called the mill rate, which is determined from the state, and the treasurer's office. And then they generate your tax bill off of those values from there. But our office's responsibility is to figure out what is this total depreciated cost. The system will figure out 1/3 of that from there. You won't need to take that into consideration at all. Just make sure that you've gotten your total depreciated costs correct. Our system will figure it out from there. You send it off to the treasurer's office. They will generate your tax bill from there. Because the mill rate fluctuates from year to year. Like sometimes more money is allocated to APS, sometimes it's more allocated to GCD. Sometimes the flood authority or the water utility authority. It all kinds of, it fluctuates from year to year. Sometimes more money goes to UNM, sometimes more money goes to CNM. It varies on a year-to-year basis, but you always will see that on your notice of value. It'll tell you what your mill rate that you're being based on is. And then in your notice of value, will actually give you a breakdown on everything from what your tax bill is, where those funds are actually being allocated to. Like this amount is going to APS, this amount is going to APD, different types of things like that. Now, when I came into this position, I realized that there was a lot of things that we kind of needed to clean up. Many people were turning in incomplete reports or just straight up weren't rendering at all. So using state statute, we are allowed to enforce penalties and or fines and or forced assessments if people don't render or turn in incomplete reports. Because turning in these reports every single year is a state mandated statute that everybody needs to follow. And so there is penalties and repercussions if there is a report that is not turned in. So if you turn in a report after the last day of February, there's a 5% penalty on the taxes that are ultimately deemed to be due for that given tax year. If reports are considered incomplete, starting from this year going forward, you turn in an incomplete report, there is going to be a forced assessment on that account based off comparable business properties. So we will do research to find the most apples to apples situation on a way to figure out a valuation of that account. Because there was no federal tax documents to go off of to actually get your fair and equitable assessment, but we still have to give you an assessment. We can't just go off of verbal or just a zero written on the back. We need something to actually go off of there. So we will look at same business type, year of business start, incorporation dates, size and scale of business. There's many variables that we can go to make sure that we're doing most apples to apples comparison to be able to determine a forced assessment. And most times we do forced assessments to give the incentivization for a business to turn in their proper documentation to get back into compliance. So if they've just written in a zero, we contacted them for their documents, we never get anything back from them, they get a forced assessment and all of a sudden they call us when they get their notice of value. Like, why am I getting a tax bill? I told you guys I was at zero. Well, no, you have to justify it. we enforce assessor. From there, you have 30 days after getting your notice of value to protest your value. That's a very, very strict statute within the state. So if you turn in a protest, that re-triggers the whole process. They're like, okay, well, you didn't give us what you should have given us before. Please give us your tax documents now, and we can try to resolve your protest before having to go to a formal board hearing. If you protest and you still refuse to give the tax documentation, then we can go to a formal board hearing. And we will present our case. You will present your case. We will stipulate that we did not receive the state mandated documents to actually go off of to get a fair and equitable assessment. And from there, it's whatever the board decides. After that judgment comes in, if they end up deciding to go in your favor with no tax documents, we're going to challenge it, and it'll go up to the next step, and it'll go to district court. And so that's when it starts going through the legal system from there. This is our second year of using a new program called Smart File. It's much better online filing system than we had before. This program will walk you through each and every single one of the steps. And what's also cool about it, it won't let you turn in a submission unless you attach your proper tax documentation. It will not let you submit, but it'll walk you through step by step on how to actually go about it. If you use this QR code, it'll take you straight to our website. But also, if you go to that link that's at the top, it'll be at the bottom of the page. That'll take you right to Smart File. It'll ask you to create an account, and then you'll want to use your access code that's on the report that was mailed out to you. Something we're going to clean up for next year because some people are getting confused, and something that I personally should have caught this year. On the report, it says access code, but in the system, it asks you for a PIN number. Your PIN and your access code are the exact same. And by chance, because we mail out early, like by state mandate, we don't have to send out these reports until the beginning of every year, until January 1st of every year. We aim to mail out in the middle of November to give everybody an extra 6 weeks to do these reports, to try to get them in on time and everything from there. Let's say you get your report in the middle of November, and you're like, oh, I got all this time to turn in my report. I'll set it off to the side. Next thing you know, you've lost your form, don't know your access code. Give us a call. If we verify that you're an authorized agent or an authorized contact for the account, we can give you that access code, and you can be able to move forward with it from there.
So I work for an accounting firm, so we get a lot of different people asking us to do this as part of the service we do. So we would have to have a login for each account that we do, or can we have it as just our account that we file several?
Yeah, so you can create an account for yourself, and then you can file multiple reports within your own account, as long as you have your client's access codes.
Okay. Do you prefer us to file that way?
We're moving this way because if only you guys could see how much paper that we do.
Oh, I can only imagine. That's what I'm just thinking. Like, I'm assuming you want us to do this.
This is the way that we're trying to move forward for the future, because we still have businesses that prefer to use fax machines. So we're trying to move towards this way, but we're willing to work with businesses if they want to file online, if they want to make a PDF, if they want to email it in to us. We have a direct, it'll be here at the end, but our direct email is on bpp@burnco.gov. That's our main email that'll come to our team that we can be able to. And we'll email you back saying this is received, so that way you have a confirmation that your report is in. And then if you send something in, we pull it up and we start to go through it and we notice a glaring error, or if there's no tax documentation, we'll email you back right real quick. Be like, wow, we've received your report, but we don't have your validating information to go off of your value. So. I want to say thank you all for watching this presentation on business personal property, also known as BPP. I would like to send my appreciation to the business owners and accountants. You are an amazing part of our community. I appreciate that I'm given this opportunity to work with such an amazing group of people. We are going to continue to try to do these outreaches, to try to continue to spread the word, to make this more well known to the public on how to fill out this part. Most people think property taxes, then they think land, building. Okay, that's my property taxes. There's a whole third different variation of property taxes, and it is business personal property. So here's some of our contact information. I just want to say thank you all for giving me this opportunity to be here with you guys. If you guys would like if you want one to adjust your clients, we can organize something like that, and we can do it. Sit there and we can actually sit there and walk through every single one of your guys' clients, actually help you guys fill it out. If they have their tax documentation with them, we can help you fill out the form. Or if you want to direct them to our office, or you can send somebody downstairs, we can sit there with them for a while, and actually we'll help you fill out line by line of the form, make sure that everything's in compliance and doing everything correctly. So just want to thank you guys all again.
Thank you.
Yes.
Maybe I'm lost, but
Yeah.
I mean, this is the first year that this is an obligation, or
No, so this
has
is
been
actually,
around many years?
yeah, so it's actually been in place since 1978.
Oh, wow.
Yeah, and it's just, it hasn't been publicized as much, hasn't been as much outreach. We're trying to get the word out, because when I came into the position, I was just like, man, like, so many people will call in because they're like, why did I get this form? I don't know what to do with it. And some people just throw it in the trash and disregard it. And then all of a sudden they're in non-compliant status, and may be subject to fines and or penalties. It's like, no, we want to help nip that in the bud before we get to that point. We want to work with you. So to be able to do anything like that. So yeah, it's been in place for quite a while. We've had many calls of people being like, I've been in business for 20 years. What is this, something new? Why are you guys trying to tax me on something else? And it's like, no, this has actually been in place for a while. You've just been out of compliance for 20 years. The penalties haven't been enforced for many years.
So you guys cannot go back and charge this 20-year business that didn't know about this?
Yes, we're not trying to endanger business, especially small businesses like this. Our goal is to bring everybody into compliance from here going forward.
Okay.
Yeah, that's our goal. We want to work with the businesses. We don't want to, especially nowadays in time and inflation and everything. It's like, don't even get me started on that. We want to make sure that we're not trying to put people out of business. We just want to make sure to get them back into compliance.
So basically, you just don't have to, you have to pay your license, you have to pay the Secretary of State for the LLC, and you have to comply to this.
Yes.
So when you open this business, you only know that you have to go there and do these 3 things, but nobody told them in the places where they go that they have to comply with this as well.
Exactly.
So that'll be something that maybe the city can start kind of implementing and say, well, this is your step. This is all the step that you need to complete to be in compliance with the state.
Yeah, so that's
Right.
actually one of our goals this year. We're trying to compile because the new business startups, they already they're already given like a checklist of, all right, you gotta set up your
Right.
CRS, you gotta do all this, you gotta do all this.
Right.
They don't include
They don't
us,
include it. That's why like
us
nobody
in there,
knows.
and we're like, okay, well, we need to work with the city and the new business startups.
Yeah.
We need to be a part of your guys' checklist,
Right,
so.
We do work hard to advocate for the taxpayer and not be less intimidating.
Yeah.
So it's, and I've only been at the assessor's office for a year, but I can tell you that they have a dedicated staff that will always be kind when you call
definitely.
and help you walk the step, go through the process.
Yeah, but still, I just think that it will be nice, like when you go to the MVDA, right? I
Mhm.
mean, with the MVD, they give you a checklist. Oh, well, you need this for your driver's license. Well, you need this for your business, right?
Exactly,
To
yeah,
complete all this steps for you to call yourself a business and be in compliance with it.
exactly.
You know?
And that's where we realized that there was that disconnect. And it's
Yeah.
like,
Nobody
when I
knows.
came into the supervisor role, I was like, why aren't we being included in all this? So working with Kathy and working with Tom, it's like, we're really trying to get and working with Adriana, like, we're really trying to get the word out.
So there might be 3 people here today that we're working with, but also it leads to more and more. And of course,
Yeah, yeah.
you know, talking with your groups to let us know where we can be, so we can go through this. Again, we want to do that. So we appreciate you taking the time to be here and realizing the importance of it.
For sure.